What's going on, guys? So I have a question for you, and I want you to think about this when it comes to your money. Would you rather pay taxes on the seed or the harvest? Said another way, would you rather pay taxes on your acorn or the oak tree? Now, this is a conundrum question to consider because you're like, well, there's no tree without the seeds. But the other question is, well, what happens if the seed doesn't grow? Now, I want you to picture this because the biggest expense you're gonna have, even past debt and interest, is taxes. It is the number one expense we have to pay. We have to pay federal income tax, state tax, gas tax, sales tax. We even got a death tax, and all these other taxes we have to pay. Right? It's just like, Jesus, can I do anything? So when you look at all the amount of money that you end up paying in tax, you're really netting like 30 cents on the dollar, 30, 40 cents on the dollar after all the tax that you really don't feel. But think about it. You get a paycheck, and then when you go and you buy something at a retail store, you gotta pay sales tax. And then you got this FICA tax and all of this stuff. So all that being said, you have to consider this when it comes to growing your net worth and growing your net worth through retirement and investment accounts. So the question still stands: taxes on the seed, taxes on the harvest, which is better? Now, I'm going to give you both scenarios in terms of how to approach this. Now, many people say, well, you know what? And this is kind of what I believe, because I don't like to pay taxes. And again, I don't think anybody likes to pay taxes, right? But the wealthy and the rich, the way they stay wealthy and rich, number one, I said this before, is by leveraging somebody else's money to grow their wealth and essentially buy hard assets. But then number two, significantly reducing the amount of money that they pay in tax. Now, let me be clear. There's a difference between tax evasion and tax avoidance. Tax evasion is illegal, you'll go to jail. Tax avoidance is just being smart with your money. Now, how does this relate to your retirement accounts and your portfolios, and why does this even matter? Well, if you say, hey, look, I'd rather go ahead and pay taxes on the seed because the seed is smaller versus on the big harvest, that's one type of account. Or if you're saying, you know what, I'd rather just see what the seed is gonna do and I'd rather pay taxes on the harvest, that's another type of account. So paying taxes on the seed means you're willing to pay taxes now, and then you won't pay taxes in the future once you have this big old harvest. Now, what type of accounts are those? Now, the first basis of this is for you to understand the difference between retirement accounts and investments, okay? Investments are all around us. The most common investment is just purchasing stock in the stock market. And there's different variations of investments that you can buy, or investment products, or called securities products. So you have all the way down to a bond, treasuries, bond, all the way up to derivatives and credit default swap. All of this stuff is speculative. But essentially, the most common forms of securities is stocks and bonds. You can go open up what's called a brokerage account, purchase securities, and then that brokerage account, if it's just a standalone brokerage account, if you buy $10,000 worth of stock, let's just say that stock goes from $10,000 to $100,000, you have a $90,000 gain, you're going to pay tax on that $90,000 gain right now, typically, because it's just in a normal brokerage account and it's not really set up for you to defer taxes. So it just really depends, before we get in this road, how you're gonna have those accounts set up. So if you're just buying stocks and it's not set up in any type of vehicle, you're gonna have to pay tax on the sale. So you can defer tax, but the point I'm making is you gotta pay tax. So that's one type, buying just straight up investments. Or the second type is purchasing, or setting up, I should say, retirement accounts, like a 401k if you have a job, or an IRA if you're an individual, or a SEP IRA if you're self-employed, or a 403b, or any other type or variation of retirement account. Now, typically, what people do is they say, look, I want to put away these retirement accounts are what I call IRS tax codes, which allows you to contribute money on an annual basis up to a certain limit. And then once the money is inside of that IRS tax shelter, we'll say, you can go inside of that and purchase those investments. Now, why is this distinction important and why am I breaking all of this down for you? You have a retirement account and you're investing in a retirement account. You're saying, hey, look, I'm okay paying taxes in the future because typically if you make $100,000 and you put $10,000 in a 401k, what that does this year is it lowers your adjusted gross income. So instead of you having to pay tax on $100,000 in income, you pay tax on $90,000 in income. And then going back to that same scenario with the stock, let's just say you have a 401k, it lowered your taxable income today. And inside that 401k, you bought some type of investment portfolio, and an investment portfolio for $10,000 went from $10,000 to $100,000. Well, there's a $90,000 gain. Let's just say you do it that year. Well, you're not going to pay tax on that $90,000 right now, but you are going to pay tax as soon as you want to pull that money out. And essentially, you're going to pay tax on the harvest. That's how retirement accounts work. So you ask yourself the question, do I want to pay taxes on the seeds or want to pay taxes on the harvest? Essentially, what I just broken down is paying taxes on the harvest. The question is, well, how do I pay taxes on the seeds? And there's two strategic ways that you go about doing this. One of the ways is, number one, figuring out what type of vehicle to invest in that's going to allow you to do this. Now, I said one of the ways, but it's really three types of accounts that you can do to do this. Number one is a Roth IRA. A Roth IRA means you're going to pay the taxes now, but once you put the money inside of that Roth or contribute it inside of that Roth, which has nothing to do with the retirement account, with the investments, but once you put the money in that Roth, you already paid tax. Anytime it grows, so in that same scenario, let's just say you invest $10,000, you typically can't put 10,000 in a Roth IRA in 1 year, but let's just say you, over the course of 2 years, put 10,000 in a Roth IRA. Well, inside of that Roth IRA, if it goes from 10,000 to 100,000, you pay no tax on the $90,000 gain because you've already essentially paid taxes on the seeds. That's one way. Some 401k plans allow you to do a Roth contribution option, but it just depends on the retirement account. But Roth IRA is number one. Number two way isn't associated with a retirement account contribution. It's associated with its own securities product. And typically it's municipal bonds. Now, one pro is that you're going to pay the tax up front. And then once you have invested in that municipal bond, it's going to go up at a certain interest rate. You won't pay taxes on the interest rate, but municipal bonds typically is not going to be that much in interest depending upon what the economy is doing and what the bond market is doing, all of this. The third way, and a really guaranteed way, is life insurance. And a lot of people don't even understand that you can contribute directly to life insurance policy cash values. Now, one little random fact that I'll explain, and you guys can look this up, it's called Section 7702 of the IRS tax code, and it has to do with the cash value treatment of life insurance policies. Now, in this third one, if you put that same $10,000 in a life insurance policy, typically life insurance is going to have stock market gains of 50, 60, 70%. But what it will do is give you a guaranteed interest rate and typically a dividend. Now, many people purchase term life insurance, and there's nothing wrong with term life insurance, but for the purposes of what I'm communicating, I'm talking about cash value life insurance that you make contributions to. So that cash value life insurance is going to give you a guaranteed interest rate, and you can let that money grow tax-free. And whatever your interest rate is, you can take loans out from that life insurance policy without having to run into any penalties. Same with the Roth IRA, except for the 10% penalty. So basically what I'm saying to you is that those are three examples of paying taxes on the seed first, or your income, you would have already paid tax. But once you make the contribution inside of those type of accounts, you're not going to pay tax again. Now, I won't go into much more detail because I'd have to pull out like a PowerPoint and start breaking down like this different percentages and all of this stuff. But the point I'm making to you is when you're building wealth, you want to structure your investment portfolio to take advantage of tax deferred reduction for your income this year, but also tax-free options as well. So when you get to your retirement number, you have a good combination of, you've got some tax-free income coming in, no matter what, you're not gonna have to pay any tax on that. Then you've got some income that you put in retirement accounts that you will have to pay tax on. And then if you have a brokerage account, typically you're gonna be paying taxes on the sale of those securities each year. So hope that makes sense. Taxes on the seed versus taxes on the harvest. You've got to decide. Generally speaking, if you could just completely pay all your tax now, that would essentially, in my opinion, be, from a long-term perspective, better. But you may say, hey, look, I want to reduce the amount of tax I'm paying this year, so I'm really not trying to pay that much money. So let me put some money towards a 401k or retirement account, SEP IRA, whatever the case is. And as an entrepreneur or as a business owner, most business owners have a little bit more flexibility in terms of those type of account options that are available, but you just have to be very, very clear on which one is going to be the best fit for you. But that's how it works: retirement accounts versus investments, but furthermore, paying taxes on the seed versus paying taxes on the harvest, and you make the decision for what you feel is best. If you want more information on how you can take advantage of this, feel free to click the link below and reach out to one of our advisors. We'll be more than happy to walk you through how to set this stuff up for your portfolio.